All right, guys, welcome. Dr. Mo here, digital nomad physician at digitalnomadphysician.com. So I made this little list here, and this is going to be about investing. A lot of people are probably going to find this video and they're going to be like, oh, why don't you just get to the point, get to the point? I think most of my videos are just not designed that way. So it's probably not a good, it's not a good use of your time if you're here to just get straight to the point. This is going to be a longer video. It's going to be a lot of mumbling and a lot of kind of talking through my thought process. This is investing for beginners advice that I would give myself if I could go back and sort of get information and actually listen to it. Back then, if somebody gave me information, I probably wouldn't have listened to it. But if anybody kind of wants to know what I'm going to talk about, I'll go through everything, this list that I made here, just so you get a sense of what it is that I'm going to talk about. So I kind of want to talk about investing versus income, because for the physicians who are going to be listening to this channel is mostly for physicians, we have a very high income, so we have the potential to invest a lot. But what's the difference? Because do you need to invest if you have a really good income, and you could have that income indefinitely? And then the concept of saving money, I'm going to talk about that, because you can't invest your money if you don't save money. And that is one piece that can get you into a lot of trouble. We'll talk about that. Experimenting with investments. I am not a big real estate investor, but I have real estate in different forms. Some people might love real estate investing. Some people might like gambling a little bit more, and they might do really well with gambling. So we'll talk about experimenting to find out what you like. Avoid comparing yourself to others. So there's going to be a lot about like, okay, there's this crypto girl who's got, billions of dollars, millions of dollars. And do I want to compare myself to that? There's somebody who's a stock picker, so a day trader who spends a lot of time researching a lot of stuff, spends 4 or 5 hours every single day trading. Do I want to be that person, or do I want to just kind of set it and forget it? So it really depends on what you like. And then growth versus preservation versus gambling. And the reason I wrote it this way is that your investment plan and strategy kind of depends on what it is that you should get into. Maybe you just want to grow a little bit of money that you have, or a lot of money that you have. Maybe you just want to preserve the wealth. Most of us who have a lot of money probably just want to preserve our wealth. We're not trying to have more money. And then there's those of us who just want to gamble. Like, man, I have a good income. Why not gamble and see what happens, right? So you go get into crypto, and that might be a little bit of a gamble. Not all of it is, but a lot of it is. And then the passive income idea, or the passive income concept, is that your investment can give you some passive income. And we'll talk a little bit about what passive income is and how it's maybe misused in some of the popular vernacular, but what it actually does for you. And then tax advantage accounts versus a brokerage account. So this is kind of like understanding the IRA, 401k versus just putting money in a private brokerage account, and what the advantages and disadvantages are. I'll talk about the most popular investments that I'm familiar with. I'm not familiar with all of them, but the ones that are probably going to come up in everybody's radar is the stocks, bonds, index funds, ETFs, real estate, crypto. We'll talk about Reits. We'll talk about all the different places that you can hold your investments related to tax advantage accounts as well, and private business investing. So this is sort of like if you want to be an investor, but you don't necessarily want something traditional. Maybe you want to invest in private businesses, small businesses, not just. I'm not talking about like venture capital or angel investing, but also a little bit about just private investing. There's a local business that needs something. You're willing to lend them that money. You're willing to give them that money, or you're willing to become partners in that business. And then investing in your own business. I think that's one that many, many entrepreneurs in medicine have done. They just invest in themselves. They take a ton of courses. They start businesses. They start consulting practices, and they're just investing in themselves. And eventually they'll build something that they can sell, and sort of that sale of the business is going to either give them that return of investment, or they're going to have some passive income from that business eventually, maybe when they can get some people involved so that they can run it. Finally, I'll talk about just traditional investing and picking your brokerage account, because that can get so difficult. And it's like, oh, should I go with Vanguard, Fidelity? What if they go out of business? What happens? And that sort of stuff. And then the last thing I want to touch up on is greed and fear. And the reason for that is I always find that in, whatever money I have, I'm 43 years old. I could die tomorrow. My girlfriend's cousin just died, and he was our age and perfectly healthy, and things happen, you die. And so like you're sort of just babysitting the money. The money is you're not going to take it with you to the grave. You can probably spend all of it, but if you're thinking about investing and being responsible human being on planet Earth, you're probably not thinking about investing, spending all your money. You maybe want to leave it for somebody. So hoarding can be a mentality that actually causes a lot of stress. And if anything, is something that I'm trying to get away from, even though that's actually, unfortunately, the path that I took. So I'll talk about my own path in the very beginning of this video, which is probably going to be long. And then we'll talk about fear, sort of the fear of losing all your money, fear of inflation, fear of losing the value of the dollar, lots of different fears of currency and stuff like that. So I'm sure I lost a bunch of you. There's a few of you who are left. So I'll kind of go through this based on my own strategies and what I would want to be told as a young physician when I first started. My journey began the exact opposite. I was a big spender, spent a ton of money, had probably about $100,000 in credit card debt. I had credit card debt. And then I had $250,000 in student loan debt. I had $65,000 actually car lease, not even a finance of the car. So I was in really bad debt, and I just didn't understand money. I didn't have good role models when it came to money. And then at some point I decided I wanted to have financial independence so that I could get out of medicine. But for me, the goal and the strategy was to be debt free, have some money that can give me a little bit of income so that I can live off of it. And I think over time, my concept and mentality has grown and matured quite a lot. So over this entire next bullet points that we'll hit up, I'll kind of tell you how I've sort of grown in that sense. So investing versus income. Investing means I put money towards something. That means I have to have an initial amount of money that I put towards something. And once I put it in there, that money will either grow. So now I'll have a bigger pocket, a bigger bucket of wealth, or that money will give me a little bit of income every single month. For example, if I put money into a stock, I say, okay, Walmart's going to go up. I buy a bunch of Walmart stock. 10 years later, I sell it. I made a bunch of money. Another option is I put that money into a bond, and a bond is going to give me a little bit of money every single month, maybe 1%, 2%, whatever it might be. And so that bond is going to give me a steady income every single month. So it's like that income versus investing. And then there's this other income that we as physicians have. We have a lot of income coming in as physicians. Like I work a few hours a day and I make probably about at least 7,000, probably close to $10,000 a month. Let's say it's 7,000 a month. It's so difficult to keep track because I do have a lot of different healthcare consulting clients, and I do telemedicine, and I do this and I do that. So 7,000 a month for sure, with 1 or 2 hours of work a day. And so our income potential is really high. If we work in the urgent care just 1 or 2 days a week, as I recorded for you guys not too long ago on the podcast, $10,000 a month pretty easily. So the income potential for us is very high. And if we can find the kind of work that we love, whether it's healthcare consulting, healthcare medicine, or something completely out of it, then you always have a steady income. So then the question becomes, do you need money that you've invested? You need to get into the investing game? Absolutely not. I'm convinced of that. And I think that's in some ways the way I've kind of become more mature, is that, you can either find something you love doing that you can do indefinitely, that you never want to retire from, or you can save up a bunch of money, hoard it, get it together and invest it, and then get that passive income from it. Neither is wrong. It just depends on what you are, who you are and how you are, what you like. I just never thought that in medicine I could find the kind of thing that I love doing indefinitely. And now I found out that I can. So I think that's been some of that growth stage for me. Next one is saving money. So if you're going to invest money, you're going to have to save money. And that's probably something that's very difficult for physicians because we have a lot of money coming in and it's difficult to keep track of all of that. It's very easy for the money to just very quickly disappear. So you give 1,000 here, you spend $500 there, you spend $200 there, $100 there, and all of a sudden it's gone. So one of the things that I think is really critical when it comes to investing is you have an investment plan. You decide that every month $1,000 is automatically going to get deducted out of my account. And that's what I've done here with my Vanguard. So I'll take you over to this other window. And every single month I have $1,000 getting, actually I get every 2 weeks, $500 deducted from my account, and it goes to investing. Now I have about $500,000 in this account, but there is private stocks. So there's Alibaba, there's Costco, which I've bought. And then there is other stuff like Vanguard Emerging. We'll talk about this in a little bit. It's index funds. There's some bonds. There is some private international stocks. Here I have some regular stocks. And it's a good amount of money. It's quite a bit of money. It adds up, and so when you regularly invest, the money goes up, and that's kind of the compounding interest, which we'll talk about in a little bit as well. But just getting that plan that you're gonna invest, you got to save money. If you don't know how to save money, you're not going to be able to invest. So experimentation, and the reason I put this here, and I think it is really important, is some of my friends are pure real estate investors. All their money is in real estate. Others are pure gamblers. They're all about buying a stock, waiting, guessing what it's going to do, selling it as soon as it does, selling their losers, that sort of stuff. And some of my friends are like me. They're sort of passive index fund investors, I'll say. So basically they invest in one index fund that owns a bunch of stock or a bunch of bonds, and they just let it ride. They just let it grow. Every one of these has its own downsides. For example, real estate to me takes a bit of work. Individual stocks takes a lot of work because you got to, like, one of my friends is he's a radiation oncologist, and every morning for 2 hours he's there trading, and he's a radiation oncologist, so he makes about $1 million a year, or $750,000 a year. He makes that amount in his day trading. So he says the amount of money he's going to make in one day, he's already made in. So like, let's say he makes somewhere between $5,000 to $8,000 a day. He'll make that in the morning before he goes to work, and then he'll make that on top. But it's a lot of work. It's an hour or two before he even rounds on his patients, and he goes to work pretty early. So it just depends on what you like. So that's the experimenting, really figuring out what you like. And I think the only way you're really going to know is to actually put some money in something. Put a little bit of money in crypto. Buy a small, tiny $5,000, $10,000 piece of property. Everybody says it can't be done. Everybody told me I can't buy a property under, I don't know, what was it back then, $300,000 in Portland. I bought one for 140, and now you can buy some for 100,000. So just put some money into something, especially if you're a physician, you can afford it and you can kind of experiment with it. What is a $15,000 piece of land? What can I do with it? $50,000 property in Texas, what is that going to do for me if I rent it out, if I own it? What are the holding costs? Like, all this stuff is something that you'll never really know unless you experiment. The next point here is avoid comparison to others, right? Okay, so going online, or just looking at what I have, right? You might look at me and being like, Dr. Mo has a net worth of over $1 million and he's only 43 years old. Okay, so how am I ever going to get there? I have kids, I have this, I have that, and it's not possible. Well, comparing yourself to somebody else is never going to help when it comes to investing, because what if I got an inheritance? What if my investing strategy is much more aggressive than yours? What if I'm willing to take a lot more risk? What if I had some inside information that you didn't have, right? So we can't really compare ourselves to other people. We can only compare ourselves to other people who are like us. They have the same investing mentality and strategy, and that makes sense. Then I think it's a good idea to compare yourself to that person, because you guys can kind of keep each other on track. And that's actually what I had when I first started investing in 2012. I found this girl online who was on the same forums, and me and her started just comparing notes, and me and her both just started paying off our debt and investing. And together we really were able to make a big difference and make a dent and save a lot of money for ourselves. But comparing yourself to others and how much money they have, and also trying to listen to mainstream advice that you need $5 to $8 million to retire as a physician. I think that's wrong advice. But you'll have to figure that out on your own, right? It's not for me to say. I do the math for myself, and I imagine right now, if I'm 43 years old and I have $5 million, that's a passive income of $200,000 a year. Why would I need that? My lifestyle is about $3,000 a month. Not even. It's in Mexico, it's like $1,000 a month, and here in Spain, it's like $1,500 a month. And in Portland, it's probably about $3,000 a month. In LA, it's probably about $4,000 a month. So why would I need that amount of income? Because I would have to save that kind of money. So avoid comparing yourself to others and kind of the mainstream stuff, and really figure it out for yourself and on your own. The next one is growth versus preservation versus gambling. So this is huge. You can invest for growth, meaning I buy a stock that I'm hoping will grow over many, many years into something really big. That's a growth strategy. The other one is a preservation strategy. For example, someone like myself, where I have all the net worth that I'm ever going to need for the rest of my life, I just want to maintain that right now. If I were to try to just continue growing that, I could, but it wouldn't make sense, right? From any kind of investment strategy, it wouldn't make sense. Because at this time, you want to make sure that this at least stays for you. When you want to get more growth, you have to take more risk. That's the way the market works. It's like in medicine. You're never going to give somebody a medication and not have a side effect. You're always going to have a side effect. The question is the side effect worth it? So we're always gambling a little bit. It's the same thing here. Now, if you do want to gamble, there's this other part, like I invest for growth, I invest for preservation. So growth, preservation, and then gamble. So the gamble means you're willing to really speculate on something. You might buy a $5,000 piece of land and you're like, I'm just going to hold this because I think this is going to go to $500,000. Perfect. Do it. If you think that's your strategy and that's what you want to do, do it. You'll have to do it to experiment to see if it's worth it. You might buy cryptocurrency and say, I think this thing's going to be a big deal. You buy it at $200 and it becomes $50,000, which is what we've seen with cryptocurrency and kind of like this sort of hype in the market that you can get really rich by investing in cryptocurrency. Passive income. What is passive income? Passive income is when you don't have to put in any work, but the income keeps coming in. What's a good example of that? If I buy a stock like AT&T that has dividends, let's say I invest $10,000 and every year it gives me 2% dividends, then I'm going to get $200 every single year, right? That's the way it works. So every single year, I don't have to do anything. I get passive income. But is it really passive? Well, there's probably a little bit of work, right? Maintaining the account, which is negligible. But you had to get that money from somewhere. You earned that money somehow, or you had a relationship with some sort of family member and you got left a huge inheritance. So there's some work that went up front. So passive income, as in real passive, there's probably no such thing. But eventually, once you put in enough work, a lot of things can become passive. On my website, before I had to take it down, I was selling courses online. And so I created the course. Sure, it took me anywhere between 1 to 4 hours to create the course. But once I did, I just sold it for $500 every single time. $500, $500, $500. It just kept coming in. That was pretty passive income. And then the other thing with my investments right now, when you look at my brokerage account, which I think it logged me out. Let me see if I can log back in. All right, here's the account. And you can see the holding is a fund called VTSAX, which is a total stock market index fund. So it's a bunch of different stocks held into one index fund. And basically the way this works is I have $119,000 here. And so I have about 1,000 shares. For each, for this entire amount, somewhere between 1.5% to 2% every year, I get a passive income for this. So there is income that comes in from this, from the dividends of these investments. So you can see here, I had a $430 dividend in December 23. So that's $430 that I can put in my pocket or spend on something. I don't owe it to anybody. It's pretty much free. Well, it's not free, but you know what I mean. And then what I usually do, I just reinvest it. So you can see here, I bought a little bit more of the funds because I like to reinvest my dividends. I don't need to spend it right now. I have no need for it. Over here, you can see kind of like what the highs and lows of the investment are, what the expense ratio is. This expense ratio is how much I have to pay to hold this, right? You have to pay to have a fund. Now, there are many funds which are free, so you don't have to. You can even find some that are 0% these days. But that's sort of the concept here. And that's kind of what I'm referring to when I say there is a passive income that I get. So if I have $1 million, how much passive income would I get? Well, it depends, right? If you have real estate, it's possible to get somewhere between maybe 8%, 10% from your total investments, maybe. If you're doing day trading, well, it's not passive income anymore, I think. But your earning potential from it might be like 20% if you're doing really well, maybe 15% at the very least. And then if you're doing what I'm doing, well, generally the entire passivity of it comes from only about 2%, but the value of the fund itself goes up too. So there's maybe another 1 or 2% there. So overall, it just kind of goes up, and that's kind of the earning value, the growth of the entire stock. So passive income is a little bit interesting because I think the definition can be very, very fungible. what I assume passive income to be as well is that if I have an urgent care, I start an urgent care in Portland, Oregon, and I run it initially, maybe for the first few years. Then eventually I find another really good physician. I'm like, hey, would you want to work here a couple days a week? They work there a couple days a week. I monitor them, I manage them. Maybe I'll hire another physician. I hire a couple of medical assistants, and then all of a sudden I'm like, all right, I'll just slowly step back. I step back, and now that urgent care is going to earn money kind of on its own with some management from me, right? A little bit of input, but it's passive income essentially. My brother-in-law had an urgent care which he ran for about 14 years in San Diego while he lived in Northern California. And so it was all passive income for him. He just put a physician in there. He figured out the billing. He got one medical assistant. He made $100,000 from it every single year. So it's really good passive income for him. Very little input that he needed to put in. So the other part that I want to talk about is the concept of tax advantage accounts versus brokerage accounts. Now, this is another topic that comes up. So you can invest in anything. What I mean by that, I can invest in the Walmart stock that we just mentioned. I can hold it in a private brokerage account like I showed you guys right now, or I can hold it in an IRA. I can hold it in a Roth IRA. I can hold it in a 401k. I can hold it in an individual 401k. I can hold it in a 407, what is it? What is it? 407, 407. Oh my gosh, I forgot all these names already. 403B or whatever, 457 or a 403B. Or a 401A. There's also a 401A. So there's many different places where you can hold an investment. And the reason it matters is because if I have investments, if I buy a bunch of Walmart in my private brokerage account and I sell it and I buy something else and I sell it and I buy something else, every time I sell and there's a profit, right, I have to report that to the IRS and I have to pay income taxes on it. The difference is when I hold it in an IRA or a 401k is that I don't have to pay taxes on it right now. Only in the future, once everything grows, when I take it out, I pay taxes on it as if it is income. So you're going to have to read up on that if this is a bit confusing. But there is that advantage, and that is why in my accounts, let me see if I can show you guys. That is why in my accounts I have a brokerage account. So over here, it's all basically $247,000 that I basically trade on a day-to-day basis. Not on a day-to-day basis, but I trade regularly. And so every one of these trades creates a taxable event, which I have to report to the IRS. I just download it into my tax software when I do it, and my tax accountant handles that as well. And then the next one is a traditional IRA. This is an IRA account. So this is a tax advantage account. I only pay taxes on this when in the future I take things out. But as it grows in there, I can trade whatever I want. In fact, you can hold real estate in there. You can buy a piece of art. You can buy collectible cars in an IRA. So there's a lot you can do with an IRA once you're ready to go to that level. And then the difference between a Roth and an IRA is that here, I still have to pay taxes when I take it out. In a Roth IRA, I already paid taxes. The money is coming post-tax. Right now, in my situation where I'm not making a lot of money, putting money in a Roth IRA makes a lot of sense because I pay very little tax on the income that I earn. So that post-tax money is very valuable for me to put into a Roth IRA. Back in the day, I didn't put a lot of money in a Roth IRA because I was already taxed at like 25, 30%, maybe even more. No, I think 30, 35% was the most I ever paid. And then there's an individual 401k. This is for when you open your own business, when you're self-employed, when you are a sole proprietor or S corp, you can open your own 401k. You don't need a 401k from an employer. I could do telemedicine for Teladoc, get paid as a 1099 employee, and put money into a 401k for myself, and it would do the same thing. Obviously, I don't have that here because I chose not to invest in that. So tax advantage versus sort of like that brokerage account. Let's talk about all the different things that are out there, right? Stocks, bonds, index funds, ETFs, real estate, crypto. Stock. A stock is basically what everybody's familiar with. You can buy Coca-Cola, you can buy Walmart, you can buy Google, which is Alphabet or something, Alphabet Inc., I believe. So you can buy all of those, and then you can trade it, you can sell it, you can buy it anytime you want. A bond is basically you're lending money to somebody. That's essentially what a bond is. You're lending money to some institution or organization, business or whatever, and you're getting a percentage back. However, the difference is this is not hard money lending. This is not P2P lending. I'm not lending money to I used to have Lending Club and Prosper, and now I have, what's the other one? I forgot the name of it. Let me see if I can pull that up. All right, here's my Mintos account. That's what it was called. I forgot this one. This is a peer-to-peer lending account that I have here in Spain. I'm actually currently in Spain, in Santiago de Compostela. So this is peer-to-peer lending. You can do it on Lending Club and a lot of other peer-to-peer platforms, but this is basically lending money to somebody. Now, this is saying I'm getting about 9.45%. That's not accurate. I'm getting less because there's a few funds here that are late or going to be written off soon, but probably around 7% is what I'm getting, and I would pay taxes on that, of course, based on the income that I get. So that's hard money lending, kind of peer-to-peer lending. But bond is different in the sense that the actual bond value can fluctuate. So when interest rates goes up, bond values go down. So there's that issue. Index fund, I already talked about it. VTSAX, VTIAX, all these different index funds they're an index, meaning like a spreadsheet of a bunch of different stocks and bonds or whatever you want. You can have index funds that are specific to healthcare. You can have index funds specific to energy. And that's one way to really increase your investment value. In fact, one of my really good friends, she didn't start investing until very late. And what she decided to do, she had a lot of cash. She just didn't invest, unfortunately. And so she decided to just invest in things in index funds that she thought would go up in value. And over the past few years, her portfolio is blown mine out of the water, let's just say. So she's done really well for herself because she's picked either wisely or gambled. I have no idea, but she's picked the right things for herself. An ETF is no different than an index fund. Think of it as the same thing, except an ETF you can buy on any exchange and you can trade it kind of the same way. Index fund, you can't really trade it on an hourly basis. You're not buying and selling. Index fund is something you buy and kind of hold for a little bit of a longer duration. An ETF can be traded pretty readily and quickly, but it holds the same thing. It has a bunch of index funds. So I can buy VTSAX in that, or I can buy it in VTI, I think it is. I don't know. It's the index fund version of it. So those are different ways of holding it. So they're kind of similar. And then real estate, you can buy into a syndicate, which you could do. You basically give your money to some big corporation who is buying up a bunch of real estate, and then they'll give you a percentage back. I think there's a lot of popular physicians online who kind of, favor that. And if it works for them, I think it's great. You can buy individual real estate. I own this flat here in Santiago de Compostela. I own an apartment in Portland, Oregon. I've been looking for another piece of real estate kind of slowly, maybe in Mexico, maybe in a certain part of California. And when that time comes, I'll buy it. I'm not in a rush. You can also invest in real estate, like a big commercial unit. You can buy a 4-unit, 5-unit, 6-unit, 7-unit apartment complex, and then you can rent that out. Single family homes, you can rent that out. You can so there's a lot of different real estate investing ideas that are out there that you could do. I invest in real estate also through Reits, Real Estate Investment Trust, REIT, capital REIT. In fact, I hold it here. Let me show you. So this is the fund that I hold right now. It's through Vanguard as well, Vanguard Real Estate Index Fund. So it is an index fund of REITs, right? So it's a REIT. And I have about $62,000. I hold it all in my Roth IRA. And you can see here that I got a dividend of about $366 for this amount. And if you paid attention, I had $118,000 in the other account, and I got just $400 for that one. So you can see that the REIT has a higher dividend. So that's another way of getting a little bit more passive income with your investments. And then I choose to reinvest this one as well. So that's a REIT, and that's real estate in different ways. And then there's cryptocurrency. Right now, there's cryptocurrency. Tomorrow, there's going to be another thing. The next day, there's going to be another thing. You can invest in farms. You can invest in solar fields and wind fields and stuff like that. There's a lot of that. You can invest in art, right? So there's a lot of different interesting investments. You can invest in cars. You can buy like really classic cars and just put your money in with that, into that, and invest in that. So there's a lot of different investments. Probably the best way is to experiment, is to buy it and see if it's the right thing for you, if it's something that you think you want to do, or maybe it's not. But some of this is investing, some of this is speculating, some of this is gambling, some of it is for preservation, some of it is for growth. And so you'll have to decide for yourself which one is right for you. Obviously, I can't tell you that, right? Because every person has a different need for something. For example, if you love your job, if you're doing great at your job and you're like, I can always work one day a week in medicine and I know I will always make like $1,500 a day, working in medicine. And 4 times 1,500 is $6,000 a month. I can, for the rest of my life, I can make $6,000 a month. I'll never need any investment. You're right. All of this, everything that I said here, is useless to you. All you probably need is a little bit of an emergency fund, just so you have a cushion in case shit happens. And then the rest of the time, you can just have fun. You don't have to worry about saving any money. Private business investing. So the reason I put this in there is I do a lot of private business investing. I go to my friend who's like, hey, I want to buy this piece of property and kind of rent it out. I'm like, hey, can I put in $10,000, $5,000? Or can I pay for the renovation and then I'll be like a 5% stakeholder? Sure. Okay, great. It's a great partnership, right? We sign a small contract. I get 5% of your gross, or I get 5% of your net income. And for that, I will put in this amount of money for renovations. Or you're starting another coffee shop and I want to invest. Maybe I'll help you with a down payment for this other commercial unit. So that's what I'm really into, and that's what I really like doing. So private business investing is one way. You could also invest in. You can be an angel investor, where you put money into maybe a startup and hope that it grows. And obviously, you can do it in healthcare if you're more prone to healthcare. And you can be a venture capitalist where you're giving money to another startup or another business, and you're hoping that in the future you'll get some of that money back. And you can do this in syndicated deals, so you're not the one doing it. You can go in with other people, or you can do it on your own. I don't have a lot more to say about that. I think private business investing is one of those things where you just know that you want to do it and you're interested in doing it, and you probably don't care that much if you put in 5,000, 10,000 and you lose it. But you might also just have a really good steady income from it. And then finally, investing in your own business, right? So I kind of mentioned that a little bit, but if you can build out a business that you can sell in the future, right? If I start an urgent care and then start another urgent care and then just kind of manage it remotely, and then eventually I sell these urgent cares, well, obviously I'm going to make a decent amount of money in the future. So that's investing in your own business, putting the money that you earn back into yourself. You might take courses, right? I took a Google Analytics data course because I wanted to learn data analytics. So that's investing in myself, because now I'm going to have that income potential from this indefinitely into the future. All right. The last three things. The last two things I'll mention. One is which place to invest your money, right? Vanguard, Fidelity, Charles Schwab, Betterment. There's so many out there. It seems like most people go with Vanguard, Fidelity, Charles Schwab, Merrill Lynch, right? I mean, if any of these go under, your investments will stay. They're not going to disappear. You're investing into the business. You're investing into the actual end product. I'm investing in the bond and AT&T and Google and Walmart. I'm not investing in Vanguard. Vanguard's just holding my money. So once the dust settles and if Vanguard ever disappears, well, all that money is going to get transferred into somewhere else, and somebody else is going to step in and hold the money for you. Same with Fidelity, same with Charles Schwab. I think any one of those three are perfectly fine. People go with Vanguard for different reasons. I think there's a little bit of a cult following that Vanguard has. I think you'll be fine having your money. I have money in Fidelity, I have money in Charles Schwab, and I have money in Vanguard. I have lots of different investments in different places, and not because I wanted to. I would rather consolidate everything under one roof. Honestly, I'd be perfectly comfortable with taking that risk. It's just that that's the way it worked out, and I'm right now too lazy to really move anything around. All right, guys, the last thing, kind of rounding this corner here, la esquina, is greed and fear. So think of it this way. You could either be cheap or you could be frugal. What's the difference? Frugal. I'm a frugal person. I don't spend on things that I don't need to spend money on, because I look for value versus price. For example, this is a blood pressure cuff, right? This is a little wrist blood pressure cuff in here. And I might say, I can just go measure my blood pressure at the Rite Aid, at the Walmart. Why would I go and purchase this, right? Or when I go to buy, that's being frugal, because you're like, I have another. Why would I buy one at home when I can go do it somewhere else? That doesn't make any sense. It's a waste of resource. Or when you go and buy one, you're going to be like, what's the cheapest one I can get? I don't care. I just want the cheapest one. And you're really just looking at the cost. You're being cheap. You're not really thinking about the value. Maybe this unit is more sustainably made. Maybe it's going to last longer. Maybe it's got more better features that are going to be better for you when you measure your blood pressure. So the point is, there's a difference between being cheap and frugal. And I think this is something a lot of us will go through. We're not comfortable paying a big tip, even though we got really good service and that person deserves it, because we're afraid we're going to lose that money. But at some point, you also realize, like, it's okay. I can part with this money and I'll be fine, but it's probably going to give this person more value than it's going to give me. Greed is the part where you just hoard and hoard and hoard and invest, and your investment value grows and grows and grows. And at some point, you're like, do I really need this amount of money? And you don't stop to think about it. So the greed begets more greed, which unfortunately leads to fear, right? The fear part is the fact that you're now afraid because all of this money that you have, you're still probably stuck in the growth phase. You're still trying to grow it. You're not really thinking about the preservation, bringing your risk tolerance down so that you can just preserve your money, so that you don't have to constantly fear, like, what if inflation happens? For example, you can invest, you can put your money in a, what is that called? SPIA, right? A SPIA is a way for you to put money into something, and then this big insurance company will just pay you out. You give them $500,000, they will pay you out a certain amount of money every single month to the day you die. And why is that helpful? Because now you don't have any stresses. Everything's on the insurance company. If the money value goes up or down or whatever, and stocks go to hell, you're still going to get your money. And that's one way. Having some money in cash, having some money in different currency can help you get rid of the fear aspect of it. But these two are always going to go hand in hand, and they're going to balance each other. I think getting rid of the fear, you can get rid of the fear by educating yourself, understanding a little bit more about the different investments out there, and maybe diversifying your portfolio, having a little real estate, having a little index fund, having some stock, bond, crypto, can help you feel a little less fearful, because if stocks go down, bonds might go up, real estate might go up, real estate goes down, and then crypto goes up, right? So there's different ways of investing to kind of mitigate that fear part. And then the greed, I think, is to know what you need, know how much you need. If you know how much you need, you save just that much, you're done. You don't think about saving more money. You're not trying to hoard more money. For the past few years, I'm not trying to save any money. Now I'm taking a little bit away every single month, like $1,000 from my income to put into my investments. And the only reason I'm doing that is because I'm still sort of experimenting with investing. To me, this is a bit more of a fun now. Like, I'm just trying to figure it out. What is investing? What does it do? And my plan is, if I leave all this money, hopefully I can leave it for family members who are going to outlive me, leave it to a good cause, or I have no idea what I'm going to do with it when I die. But that's the plan, is to do something with it. It's no longer just for myself to spend, but it is now kind of beyond that greed stage. And it's like, okay, let me do something good with it. But knowing when to stop, I think, can mitigate greed as well. That's it, guys. That's everything that I have. I think I've mentioned all the investments that I hold myself, these two real estate properties, some of the private business investing that I do. I have Reits, I have ETFs, I have index funds, I have individual stocks. I don't hold individual bonds, obviously. It's not common. I have an index fund of bonds. I hold that. I have bought some cryptocurrency, about $15,000. My real estate, this one is worth about 100,000. Yeah, let's say 100,000 euros. And then my other one in Portland is worth about $150,000 US dollars. I have, $200,000 in some old 401ks. I have another $200,000 in some other, it's an odd Charles Schwab account. Let's just call it a KIO from Kaiser Permanente. And then I have the funds in Vanguard that you guys saw. So there's some Roth IRA, some brokerage accounts. So I have those funds, about 500,000 in that. And then I hold a little bit in, as I mentioned, the cryptocurrency, a little bit in peer-to-peer lending, a little bit in cash accounts, a little bit in other cash accounts, some money here abroad in Spain. I have about 5,000 euros here in Spain that I keep in a small account. So those are the different investments that I do that I think are good for me and make sense to me. And I'll continue doing it, and I'll continue experimenting and learning. But for sure, one of the best investments I've ever made is to just keep earning money instead of saving a ton. I hope this is helpful. Leave any comments below. I think the majority of this is mostly for physicians. At least that's the advice that I would give. This is for physicians, as a physician, who wish I had some of this knowledge early stages of my career. I wouldn't have followed it for sure. I was way too hard headed back then, but I think it would have been a good primer for me. Take care, guys.